Hello, everybody. My name is Ty Bernicke, and I'm going to be bringing you the monthly market update for October 2022. And part of the reason we wanted to do an update now is because a lot of people have questions and a lot of people have concerns about the state of the stock market and the bond market, and I wanted to spend a little bit of time reflecting on where we're at. And I apologize if I seem a little redundant. I'm going to share a chart with you that I also shared with many people during our client appreciation event in June of this past year to address how long does a bear stock market last. So if you look over here on the left-hand column, you can see it shows the peak years, and that's where the bull market tops out at. And then this next column shows the trough, and that shows how long it takes from a bull market to turn into a bear market and hit its bottom. And the next column shows the percentage of decline for every bear market that we've had going all the way back to 1950. So you see we had one in 57 and 62 and 66 and 70. This includes every bear market we've had since 1950, with the exception of the most recent one. And it shows the amount of the decline of each of those bear markets in the third column to the left. And if you look at this last column on the right-hand side, you can see the length of time it took for these bear markets to fully recover. On average, if you look at the bottom right-hand side, you can see on average it takes about 1.7 years for a bear market to fully recover. Now, there have been time horizons where it's taken over 5 years, like in the 1970s, and a few times where it took over 4 years for a bear market to fully recover. But generally speaking, 1.7 years is the average. Now, in addition to stocks having a tough year, this has been arguably one of the worst years we've had for bonds, which is the bad news. If I were to try to see the world with rose-colored glasses right now, one thing that I think is worth pointing out, even though this has been a really bad year for bonds, it doesn't necessarily dictate that now is a good time to completely get out of bonds. And the reason I say that can be illustrated in history. If you look at this graph, you can see it goes all the way back to the year 1928, and it shows you the yearly returns for bonds each year going all the way back to 1928 up until recently. And you can see that all of these little down lines that you see on the bottom, those are the years that bonds went down. And what I really want you to focus on is if you focus on those years where we have the big declines in bonds, you can see that they're generally followed by really good years in bonds. So just about every decline we have is followed by some good years in bonds. And so we don't know for sure if the markets will repeat themselves in the future as they have historically speaking, as it pertains to bonds, but certainly one bad year in bonds doesn't necessarily mean that the next year is going to be bad. In fact, historically speaking, it's been the opposite. Obviously, we do have concerns that we talk about daily here and that we're looking into. The Russia-Ukraine war is something that we're following closely. Inflation is something that we're talking about just about daily in our office. And as you can see by this chart, what we've seen with all items inflation related, inflation's just been rising steadily since last year, and it hit its highest point as measured on a 12-month change here in June. And it's been declining a little bit since then. It doesn't mean by any stretch of the imagination that this trend will continue. Things that we're keeping a close eye on as it pertains to inflation is obviously the Federal Reserve continues to increase rates to try to slow inflation down. We're also keeping a close eye on the consumer. During the COVID years, on average as a country, we had saved up a lot of money in our savings. And recently we've seen a trend that might illustrate that the consumer is getting more and more fragile. And specifically what I'm referring to is we've seen savings levels decrease and revolving debt levels increase. And what that could imply is that people are not only saving less, taking on more debt, and they might be whittling the savings that they had from the COVID years down lower and lower, which would imply that the consumer is more fragile today than they were previously. And for this reason, obviously, it doesn't mean a recession is imminent because nobody's been consistently good at predicting recessions, but it definitely has our cautious level a little bit higher than it has been, our caution level a little bit higher than it has been historically speaking. Some of the things that we started doing from a portfolio management perspective starting in June of last year is we turned down the maturity dates of the types of bonds we were purchasing in our qualified LPL accounts that we're managing for our clients. In addition to that, we've placed a higher degree of emphasis on value stocks in this past year, which we perceive to be our way to lower risk. In addition to that, we've been keeping a close eye on the bond markets and the stock market and have been making adjustments which are a little bit more on the cautious side. The thing that we haven't been doing is we haven't been blindly selling our clients out of large swaths of stock portfolios or bond portfolios because we know the downs are always temporary, and we know that there hasn't been anybody in the history of our country that's been consistently good at making accurate predictions over short periods of time and what the stock market or bond market is going to do. Furthermore, I think it is also important to note that the stock markets and bond markets to a large extent are forward looking. So even though a recession could hit 1 month, 2 months, a year from now, it doesn't necessarily dictate that the stock market will drop as a result of that, because the stock market is looking into the future. And for all we know, it's already pricing in a future recession. And so if a recession does hit, it doesn't necessarily mean that the stock market will go down further, because the stock market, again, is forward looking. It's already anticipating things to slow down in the future, which is why we've seen that dip. So we'll continue to keep an eye on this. I wanted to do my best to give you a real quick update on what our thoughts are and what to expect for the future, to the degree that we can see things based on what history has shown us in the past. As always, please feel free to give us a call if you have concerns, or if there are things that you want to go over, or there are things that are keeping you up at night. Other than that, I hope you found this helpful and hope you have a wonderful day.